Welcome back, everyone, to another Beyond Moon episode. Today, I'm going to explore crypto and the opportunities in the digital asset space for passive income. Today's conversation is going to be with German Cardano stake pool operator, Mattias Winter. We have an incredible conversation where we talk about the investment opportunities for the retail investor like myself to utilize my asset in the validation process of the Cardano Shelley mainnet through a staking pool. Now, the beauty of this conversation is that it's going to be centered around me, Jerry, and my Daedalus wallet that I have in my possession on my computer, where I hold my ADA tokens. This is very important for me as I want to minimize risk in this digital asset space. If I don't have control of my tokens in my possession, well, we've all seen weird things can happen. Hacks, this, that, and the other thing. Anyway, we're going to open up my wallet. We're going to go step by step through the process, as well as explaining the different criteria that's listed in each stake pool operator profile, and talk about big pools, little pools, and the governance code written in the Shelley mainnet for reward distribution and how really even and community oriented it really is. So enjoy this conversation. Please like and subscribe. Leave your comments. They're so crucial to the development of new content for this channel. So I hope you enjoy this conversation. It's coming at you right now. Mattias, thank you so much for taking the time to join me today. How are things on your side of the world?
Hello, Jerry. Very happy to be here. Thank you very much for the invitation, first of all. I'm doing great, actually. I'm in Germany, so I'm like really on the other side of the world, and yeah, I'm doing fine. Thank you.
That's excellent. These technologies like Zoom that are allowing us to have this conversation, they're so incredible. They weren't around 20 years ago. And to have them now and to facilitate something like what we're going to do today, to me, is just incredible. It's just an example of how far we really have come. So we have these incredible video and voice over IP technologies. We have these incredible value propositions in the form of digital assets. And that is why I've got you on the show today. This is part of my series Beyond Moon, where I try to help investors think about ways to capitalize on their investments. And what is so incredible about today and having you on is that for many years in the cryptocurrency space, the investment proposition was one that was solely centered on capital appreciation. That meant if you invested in an asset at 10 cents, that your goal was for it, the underlying asset, to appreciate in value. And that is only one element of investing, capital appreciation. It's like if you only played the stock market and you only bought stocks that you're hoping will go up in value. Recently, with the advent of proof of stake protocols, we've been introduced to a new element from the legacy investment world, and that is a way to create a passive income through new asset generation. And so for the viewers at home, Mattias is a Cardano stake pool operator where you can pledge your ADA tokens to his validation pool and receive an approximate share of the staking, of the validation rewards given out by Shelley, the mainnet, right, as part of the code. So why don't you walk us through, in your words, what staking is, and also a little personal, how you got involved and why you decided to dedicate your time, your energy, your computing resources to staking on the Cardano mainnet.
Yeah, absolutely. I mean, thanks a lot for the great introduction. You already brought some very interesting facets into this whole topic. So let me start with the last question you gave, which was basically how did I get involved? I think as nearly everybody at some point who ended up in the crypto world, I was introduced to Bitcoin some years ago. And first of all, I didn't quite get it. I was there quite early, and I had a friend who told me about it and that you could mine virtual coins, and told me a bit about proof of stake. And I didn't really deep dive into it. And of course, I regret that now because it would have been like the gold digger times. But a few years later, around 2017, as most of us most likely, there was this huge hype about Bitcoin. There was this massive bull run with so much money flowing into the crypto world. And so I come back to these technologies and took a deeper dive. And what are they about? And it was quick. On the one side, I was amazed by the technology behind it, by a decentralized system that works without central authorities, and is a combination of individuals all around the world contributing to one common goal. But on the other hand, as we all know, proof of work has its flaws, its obvious flaws, which are the resources that are needed, the massive amount of energy that's kind of wasted, if you want to call it that way. It's not exactly wasted, but it's at least it's questionable if that is like the perfect solution towards this this common goal that we have to have a decentralized and autonomous currency in the first place. So I started to look into alternatives, and the most promising one was actually proof of stake. And when you started looking into proof of stake protocols, Cardano was one of the, at this point, already most hyped ones. It was a short time after the ICO. I think Cardano was around $1 per coin. But it was just a white paper. It was a great vision. It had tons of academic research. It sounded super, super interesting, but it had a long way to go, as we all know, until all these ideas come to fruition. So I bought some ADA, put them in a wallet, and kind of forgot about them until they started to release the first node versions of Jormungandr, which were a few months before the so-called incentivized testnet started end of last year. And that was the point where at the first time picked up a Cardano node software, started playing around with it. How does it work? What's the technical background you need to have? Can somebody learn it? Is it too technical to be a solution that maybe not everybody can use, but at least the hurdle is not that high to make it exclusive, but to make it inclusive in the end, because that's what we need. Which I think is another downside of the proof of work protocol, because as a individual, as a private a person, there is no way you can compete in this race of technology. There was this one idea at the very beginning of Bitcoin, which was one CPU, one vote. And we all know how far we've come from that. So Cardano Cardano is a lot more in this original vision that I had when thinking about cryptocurrencies and thinking about inclusive protocols.
Well, I'll tell you, one of the things that I found very attractive from listening to Charles Hoskinson talk about this is before, this had to be, I believe, even prior to the test net going up. So this had to be at the end of 2018-ish.
Mm-hmm.
Boy, time, I don't remember exactly what time it was, but it was early days. And I remember catching a conversation that he was having where he outlined the concept for the distribution of the rewards through the proof of stake protocol. And one of the things that caught my ear was that there would be a built, so this is all code, so it's not changeable unless the entire ecosystem says it's going to be changed, which is attractive to me. And what he stated was, in the form of this governance code as it pertains to distribution of the rewards for validating the transactions on the ledger, that it would be randomized, which was huge. That word randomized. In other words, it's not going to the most computing power. It's not going to a predetermined favorite, right? Or somebody could build something that the system would recognize as the preferred favorite. That was big. And then the second, he talked about that it was being built so that as the transaction community, so the validators, the participants, the stake pool operators as we know them today, that regardless of how many came into the system, between the randomization, there would be additional code for what he termed fair distribution. Fair distribution. And I was thinking to myself, if you're going to write into the code randomization and fair distribution, then it doesn't matter if there's 1,000 stake pool operators or 10 million stake pool operators. Even distribution is even distribution. So to me, as somebody who understood the proof of work concept, that the more ASIC rigs you could throw at the proof of work network, the better your chances for earning the Bitcoin reward. I'm sorry, the coin reward. That creates a very, it becomes an arms race at that point. Who can throw the most money at it to capture the most money? And this fair distribution randomized model seems to, and back then it spoke to me that this was going to be the one. If I was going to get involved, this would be the one I'd want to get involved in, because it almost guarantees fair play regardless of the size of the network. Now, do you recall hearing things of that nature, or can you verify that those things are actually in existence today?
Yes, absolutely. I mean, I think that is one of the main ideas or the core focuses of the whole development of the Cardano protocol by IOHK. There are actually several factors towards guaranteeing or trying to achieve this kind of fairness and balance. And maybe that is one of the downsides, if you can call it like that, of the Cardano protocol, that you might be a bit overwhelmed in the beginning by all these parameters and factors and dozens of white papers and quite the academic approach that might be a bit overwhelming in the beginning. But if you break it down to like the most relevant ones, they are exactly focusing on this goal to make the distribution fair, randomized. Kind of, it's a part of that, but also try to avoid this this, yeah, how did you call it, like the
An arms
technical
race.
race, like, yeah, exactly, like the one that got the most money is the one who can rule the protocol and also make decisions on the protocol, because it's not only about rewards distribution. Later down the road, it's also about making decisions on how to change the protocol, and maybe even roll back ideas that have been beneficial, to turn them into something that gives the most advantage to you as an individual, which we don't actually want. So there's a few things to that. One thing that they introduced is called the pledge. So each stake pool operator, if he wants to run his own pool, doesn't have to pledge ADA to his pool. That's very important. You don't have to do that. So everybody can just run a pool and say, I got 1 ADA, I pledge 1 ADA to my pool and run that pool. But it will not be competitive towards a stake pool operator that says, okay, I'm going to pledge like 100,000 ADA, 500,000 ADA, 1 million ADA. And the idea behind the pledging is that not a single person or one entity can just spin up like hundreds or even more pools, and try to accumulate a huge percentage of the total ADA in circulation. So that is one metric that they introduced on the protocol level. We have seen what happens if you do not introduce a pledge factor, because that was the case on the ITN. The ITN did not have pledge implemented when it got launched. And we saw single entities spinning up 10, 20, 30, 40, 50 pools and controlling a huge percentage of the whole ADA, which wasn't a big problem on the ITN, because it was a separate testnet. The only thing that happened was basically that they created quite a lot of rewards, so it was kind of unfair, but only on a monetary level. But as soon as we have something like on-chain governance, that will be a massive, massive problem. So this is one thing that they introduced. Another metric that they had is called the saturation. So
Saturation.
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 So we are having a parameter called K, and K basically defines the desired number of stake pools, the total number of stake pools on the Cardano ecosystem. At the moment, K is set to 150. This is the first value. It's going to increase. And it does not mean that we can only have 150 stake pools. That's very, very important. We already have, like, as we speak now, we have more than 1,000 stake pools at the moment, and they are all operating. And it's amazing to see so many people taking this venture and diving into being a stake pool operator. But the important thing at the moment is that with K being 150, that basically defines how large one single pool can grow until rewards get capped. So that is currently, I think, around 207 million ADA per pool, which is basically the total amount of ADA divided by parameter K, so divided by 150. So that leaves us with 207 million ADA, which is quite a lot. But as I said, K being 150 is just the starting value. It is going to increase, we know that. We do not yet know how quickly it's going to increase, but Charles said in one of his videos in the past that he definitely sees K around 1,000 pools at a later stage. So given that, the saturation point for each pool would come down to, let's say, 50, 60 million, making sure that delegators are urged to delegate to smaller pools to avoid this centralization into one pool just because, hey, it's the biggest pool. So let me just give my ADA there. I get the most blocks. That is exactly what we do not want. We want an evenly distributed landscape of stake pools. And these two parameters currently are the tools to manage or to foster a spread out delegation landscape, so to say. So they really had exactly that in mind when they invented the protocol. How can we make sure that single entities are not gaming the system to their own personal benefit? And that's perfect, to be honest, because if we don't do that, we see what happens in proof of work. We see 3 or 4 pools having more than 50% of the hashing power. They could basically roll back the blockchain. They could double spend coins. And that is the thing that should never, ever happen in a decentralized system.
Well, you've got, I think it's important for all of us, whether you're a developer, a network participant, an investor just investing in the possible financial appreciation of this new space, that we all understand game theory, right? Game theory states that you should assume every participant in the game is going to try to maximize their rewards or return. That should just be a given. And so keeping that in mind when you're designing code, like they have been designing code that will govern and basically manage the way this protocol goes forward, I thought it was very attractive that they kept that in mind. It's almost like they thought about game theory ahead of time and said, it's not a good or bad or good versus evil kind of thing. It's people are going to look out for their self-interest and want to maximize their returns. That's just normal. And with that being said, here's what we can do inside the code to try to mitigate that. Now, one of the things you said a lot, and some of the things that you said, I want to real quickly identify. When you said ITN, folks at home watching this, that is the incentivized testnet. It's an acronym that people inside of the ecosystem use so they don't have to continue to say incentivized testnet. They just say ITN, much easier. The other element is that besides I come at this from an investor standpoint. I'm looking at, okay, if I make an investment in this digital asset ADA, yes, I am looking for a long-term capital appreciation of every single unit appreciating in value. And how I can look forward on that is, are they addressing use cases that are necessary in the world today? And for me, when I look at Cardano's blockchain and what they say they want to be able to do, I put a check in the yes mark. Okay, we've got established use cases that there are a need for that address real problems in the world. Okay, great, check. Are they building a network that can scale, grow, and adapt, evolve? Well, all the research I've done, the answer is yes. So I put a check mark in the yes box. Now the third thing is, Are they creating an ecosystem where regardless of the capital appreciation, and that means regardless of the day-to-day market for this publicly traded asset, are they creating a way for me to continue to earn? Well, the answer is yes. Proof of stake, where stake pools are being rewarded for their validation efforts in the form of more of the underlying asset. This is a win-win for anybody who is looking at creating either revenue streams, income, an income stream, or a larger portfolio without further influx or introduction of their national currency to do so. And so what I was hoping we could do is transition from the quote unquote conversation. I'll get into a screen share. I'll pull up my Daedalus wallet and we'll walk through all these various components of interacting with a stake pool. One of the parts that you talked about that I was going to wait till I open my wallet, and I'm glad you addressed it, were issues around pledging. Pledging is like voting. Voting is how changes in the network can be made. And so I think that's an important thing to understand when choosing a delegation pool. Because if I know the delegators, and like for instance, you and I are having this incredible conversation, we've had words on Twitter and in private messages. It's kind of like voting for a candidate. So for instance, when I'm looking for a stake pool to pledge my Cardano to, yes, I would like to maximize the return on my investment, but I also want to support a stake pool operator whose ideology, philosophy, understanding of the ecosystem, and the importance of longevity or sustainability is at the forefront of their thinking, because they're going to be the ones that cast their votes, so to speak. Me, the person participating in the stake pool, I'm not going to fill out a ballot box. That's something you're going to do for me on my behalf, correct? Right?
Absolutely. So
Yeah.
the
Let me open this bad boy up. There I see our pictures on the side. Okay, so this, folks, this is a Cardano wallet that I have set up. And I believe if I press that button one time, you'll see that I have 3 wallets set up. This Jerry Byron, this was the, I guess you would call it the wallet I had for the incentivized testnet, which is kind of no longer valid. But on the Daedalus wallet, you'll see this vertical toolbar on the left, the top being the wallet. The second icon here is for the delegation center, which gives you a clock, tells you when each epoch being the period of time that validations will occur. When that clock strikes 0, a new time frame will be opened up. The rewards will have been issued and we'll start anew. Is that a fair description, or let's hear your epoch description coming from a pro.
I mean, epoch is basically just a time frame between the epoch boundaries where the rewards get paid. One epoch on the Cardano mainnet is currently 5 days. Within these 5 days, we are slicing it down into what we call slots. You have it on screen at the moment. We are in epoch number 213. We are currently in slot number 419,928. And we have a total of 432,000 slots. Every 20 seconds, roughly, a block is created. And for each of these blocks, a stake pool is plan to produce this block, depending on the total stake this stake pool has. And given that it's operational and everything's set up correctly, it will produce that block, and therefore will be rewarded with data, which is going to be distributed to the delegators, but we step into that a bit later. So epoch is just a time frame. One epoch is 5 days on mainnet. That's what you need to basically understand and keep in mind.
All right. Well, I really great explanation. Thank you very much. So, folks, what I did was I knew roughly how much Cardano I wanted to put, how much ADA, sorry, that I wanted to put into my Daedalus wallet. And I made a decision to have 3 different wallets within the Daedalus wallet, because at this particular juncture today, you can only stake to one pool from a wallet. So you have to make multiple wallets if you want multiple staking pools. So I chose 3 wallets, and then I went and looked for pool operators that I wanted to stake my Cardano to. So I'm going to go to that particular tab, and you can see here that there are a ton. You said over 1,000, right?
Yeah, I think it should be over 1,000. Yeah, see, 1,032.
1,032 stake pools. Now, it's like I could see where somebody new to this would look at this and go, whoa, what the heck am I looking at? Well, you're looking at 1,000 plus stake pools. And what I'm going to do is let me pull up a random, let's hear it. We'll go 69. This stake pool operator has a name. This particular stake pool operator also has a website. And every one of these stake pool operators on this page in this format are all going to have some criteria identified, and they all have the same criteria identified, and that is where they rank, the controlled stake, their pool margin, their pledge, their cost per epoch, and their produced blocks. Let's walk through each one of these criteria to let the audience know what it is they're looking at when they go look at a stake pool operator.
Yes, let's do that. So we have, first of all, we have to mention one thing.
Okay.
The ranking within Daedalus is a quite elaborate formula based on performance data of the stake pool. So it's a combination of how much stake do they have, how many blocks have they produced, how high is their pledge, how's the margin, etc., etc. As we are quite new in the Cardano mainnet, these metrics are not yet fully available. So these performance metrics just basically lack some data. It will just take a few more epochs until the performance data are more precise, so to say. But just to keep that in mind, that ranking might change. In the very first epochs, it was even randomized to give everybody the same chance to be on top of the list and attract some delegators. But still, it does make sense to go through these several topics and explain what's behind them. So,
well, before you move on, let me ask you a question about the ranking. From an outsider's view, is it fair to assume that where a stake pool ranks in this list of 1 to 1,032, I can equate a return on that? So would the stake pools in the top 10 produce more rewards than the stake pools in the bottom 1,030?
No.
Oh,
and that is actually a good thing. The funny thing about how the proof of stake mechanism in Cardano is implemented is that over a longer period of time, assuming the pool is operating, so it's maintained properly, it's online, it's all correctly set up, the return of invest should roughly be the same. And that is a beautiful thing. I say roughly because there's one factor that will, or let's say there's two factors that will have an influence, but roughly you could expect more or less the same return of invest on the long run, actually. So that just to quickly answer your question.
Well,
So
I think it's an important distinction to make for people who are going to start that process, because I believe there's still a tremendous amount of ADA holders that are still holding in cold wallet devices, still sitting on exchanges. Maybe they're allowing the exchange they have to pledge their ADA, and they're maybe getting some reward for it. But so I think there's still going to be a tremendous amount of Cardano ADA tokens coming into wallets like Daedalus and Euro and being staked to pool operators such as yourself. So I think we put a fine point on rank. Let's go talk about controlled stake.
yes, let me quickly jump back to what you just said. That there's quite a lot of ADA still on cold wallets, or especially on exchanges. We are currently around 43% of all ADA in circulation being staked. So we are not even at 40%, not even at 50%, so sorry. We are expecting this to somehow grow up to 50, maybe 60%. That would be ideal because some of the ADA will, of course, stay on the exchanges. That's people more into day trading and all that stuff. So there will be quite an amount never ending up in staking, but everything from 50 to 60% would be perfect to have staked. So rank we talked about, it's based on performance. It's not yet 100% precise, but that will become better over time when more data becomes available. The control stake is basically the amount of ADA out of the total amount staked. So out of roughly 13 billion ADA, let me quickly jump back to my other screen. We have 13.84 billion ADA staked at the moment. So looking into Daedalus, you will see a percentage of controlled stake out of these 13 billion ADA, which is delegated to that one specific pool. Maybe SETI actually isn't the best example because it's at
0%. Well, you know what? Let me go to my very favorite staking pool. It's HRMS. This is my very favorite stake pool operator. He's a little guy out of Germany.
I'm very happy to hear that. I wouldn't have accepted any other answer anyway, so.
All right. So
okay.
Now you have two pools. You have two pools. You have Hermes 1 and Hermes 2. I chose Hermes 1. If I open up a new wallet, I may go Hermes 2. I make no promises. I don't want to blow smoke up your hindquarters there. But so if we've established rank and we've defined rank, and we're talking about controlled stake being each operator will have a numeric value of the approximately 13.5 billion Cardano that is currently being staked. So when I look at yours, you're at 0.91%. You're almost at 1% of the total Cardano that's being staked is in this one pool.
Exactly.
Well, there are 1,000 plus pool operators. You have 10 times more than the average, if I did my math correct in my head.
Yes, that's about correct. We are currently at 0.9% of the active stake. If you transfer that into a absolute number, that's around 116 million ADA that are currently staked towards our stake pool. Just because you mentioned it, there's also Hermes 2. It's a second pool that we are running. We are only running 2. There's no plan to run more than 2 pools in the future, because that would totally conflict the idea of decentralization. In my point of view, there might be other people who see that different, but that's my stand on that. So currently 116 million ADA staked towards our pool, making it close to 1%. So from a mathematical point of view, that would mean that around 1% of the total blocks per epoch are produced by our stake pool and would create rewards for the delegators at that point.
Wow.
However,
that's an incredible, okay, so let me just, so as an investor, that is a metric that will have, that I can equate or assign a value to. I can
exactly.
assign a value to expected return.
Exactly.
Okay,
So,
thank you.
I mean, first of all, you can by that value determine how regularly will the pool produce blocks. Let's assume we find another pool that just has 0.01% of the stake. That pool will most likely produce a block every few epochs, which isn't necessarily a bad thing, because the amount of ADA, so the rewards are split are split between all delegators to that pool. So the pool is smaller, you will get rewards less often, but the share for each participant will be higher.
The quantity will be higher, so the net, it's a net average that creates the quote unquote level playing field, so to speak.
Exactly.
Okay.
And that's what I meant earlier, that what we want to achieve is a fair and evenly distributed stake pool landscape. And we will only achieve that if small pools have the same chance as bigger pools. So bigger is not better in that case. What will happen at the moment is that people tend to aim for bigger pools, because everybody wants to learn how does it work. They don't want to wait 10, 15, 20, 30 days for the first rewards, even if the average will be the same. But they want to see rewards as quickly as possible to know, have I done everything correctly? How does it look like? How many 8A can I expect in rewards, etc., etc. So
Okay.
that is more like a human, psychological aspect.
It's part of the, it's behavioral economics. Let's take a look at, let's get down and get into some of this nitty gritty about pool margin.
Yes. Pool margin needs to be explained always together with cost per epoch. And when you're asking me personally, I'm not a huge fan of the naming that was chosen for these two values, because I think it's a bit misleading, and we are having a lot of conversations in our Telegram channels and on Twitter with our delegators about what these exactly mean. So I'm very thankful that we're going through that in further detail now, so we can maybe reach even more people and explain what it means.
Okay.
Let's start with cost per epoch. So this is a value that was set by IOHK before launching the mainnet as the minimum fee that each stake pool has to take from the rewards before distributing them to the delegators. So 340 ADA is the minimum fee. You can set it higher as a stake pool operator, but you cannot set it below 340 ADA. So why is that not possible to go lower than 340? And it's in the end to prevent a so-called race to the bottom.
Right.
Because what we saw on the ITN, there was no cost per epoch, there was no minimum cost set. So pools that joined a bit later tried to attract delegators by setting this fee to 0 and the margin to 0 as well. So in the end, they earned nothing. It is a charity pool, which is not how you would create a sustainable landscape of stake pools. Running a stake pool costs money. You need to have the hardware. You need to rent it somewhere in a data center or host it in your home on a dedicated line. You have to operate it. You have to maintain it, etc., etc. That costs time and costs money. And that is why IHK said, okay, let's set a minimum fee of 340 ADA per epoch, and nobody can go below that. So let's assume a stake pool creates X amount of blocks within one epoch, and let's just assume it creates a total rewards pool of just fantasy numbers, 20,000 ADA. Let's just assume that. What will happen is that out of these 20,000 ADA, the protocol will automatically deduct 340 ADA and put it into the pool operator's wallet. So after that, we will deduct what we call the pool margin. So
Right.
the pool margin is a percentage fee that each operator is free to set. You can set it to 0, you can set it to 2, as we did. We also have pools that are going with 5, 6, 7, 8, or even 10%. Kind of depends on what you think is a feasible fee that you can charge on top of the cost per epoch. And that also reflects your individual operational costs of your stake pool. Because, I mean, sure, running a stake pool in Germany for sure is a lot more expensive than maybe running a stake pool somewhere in Africa or in Southern Asia, for example, which is absolutely fine. But that is like the metric you as a stake pool operator have to cover your costs, to even make a bit of a revenue. We all have to pay taxes, for example, on the rewards that we hold back as a stake pool operator, as we are small businesses. That's how it is. So you're free to set this. Back to the example I had, let's assume 20,000 ADA, then we deduct 340 ADA automatically. After that, we deduct 2%, and all the rest, all the remaining roughly 98% of the rewards, the block rewards that we created, are spread out to the delegators. So the the majority of the block rewards created by the pool are for the delegators. And they are automatically distributed at the end of the epoch. So there's nothing that
every 5 days.
Every 5 days plus 1. So that's another thing we might need to explain. It takes one more epoch after the creation of the blocks. In this epoch, the rewards are calculated, and at the start of the epoch afterwards, they are distributed. So don't worry if you do not receive rewards in the first epoch. It takes one more epoch until they will show up in your rewards tab, which we'll look into after, I think.
Well, right on. I think that explains that very well. The form, and I think it's important, maybe just in plain English, to let everybody know, it doesn't matter what delegation pool, right? What staking pool you pledge your tokens to. It's the same mathematical formula that's written inside the code that distributes the distributable ADA evenly throughout the participants. So if one pool has 1,000 ADA from 1,000 different people, the distribution would be the same mathematically as if there were 100,000 people doing 10 million ADA in a different pool. The code is written in and happens automatically. Nobody has to do any crazy shit with it. I mean, that's just
Exactly.
kind of the plain English of it. That was excellent. There's one element here that we haven't addressed yet, one of these metrics on the stake pool profile, and that is the pledge.
Exactly. So this is the only factor that will influence the height or the amount of rewards you would receive from two different pools, assuming they have the same cost per epoch, the same pool margin. Then the only deciding or the only differentiating factor would be pledge. Pledge has a slight influence on the amount of rewards. It's not a lot currently, but that's subject to change in the future most likely. But it does have an influence. So what is pledge? Pledge is the personal ADA. So that's my ADA that I bought as a private person, and I pledged them into my pool to show what Charles Hoskinson always calls skin in the game.
Right.
So the idea behind that is I'm locking up those tokens or those coins. I have 250,000 of my personal ADA put into Hermes. I have another 250,000 personal ADA put into Hermes too. These coins are locked. There's two beautiful things about that. The first beautiful thing is by locking up those coins, and it's I don't have the number exactly, but it's several million ADA are locked up in stake pools already. So they are out of the circulating supply. So this is also something that will drive the price, which is interesting from a investor perspective. But the second beautiful thing about pledge is that it will prevent one entity to spin up tens or dozens of pools, pledging them all with one ADA and saying, okay, listen, guys, delegate to my beautiful pools. I have only, let's say 0.5% margin and the minimum cost per epoch. But because he has 25 or 30 or 40 or 50 pools, he will still make a shitload of money. Sorry for my wording.
That's fine.
So this this mechanism was implemented to work against what we call a Sybil attack. Sybil attacking the protocol, meaning to concentrate a more than 1% of the total supply of ADA into one entity, and to have a too big influence on the network. So that is currently the idea behind pledging.
Excellent. Excellent. So as you can see on the on the screen here, folks, I have my Hermes Stake Pool Germany 1. You saw the stats on the profile. In contrast, I think it's important that you understand that not everybody does it the exact same way. For instance, this is ADA Loveless Pool, your first choice for staking. They also have a .com address. You can see that they have produced less blocks than Hermes. The cost per epoch is the same. They have a much larger pledge by the stake pool operator. They have a zero margin, and they have much less of a controlled stake number. So the much less ADA in this staking pool to give to the validation side of the network. I bring this up to you folks that are watching this so that you can see the contrast when we go to rewards. Now, I'm going back up to my toolbar and I'm going to go to the rewards section. And I think this is very, very important that people see that, for instance, the Jerry Stake 1 and the Jerry Stake 2 wallets were created on the same day with an equal amount of Cardano ADA tokens in them. And both of those stake pools were decided upon and delegated to. And here are the rewards that have come. And you can see that even though there is a very large difference between the two staking pools that I'm staked in as it pertains to pledge, margin, the percentage of margin that they're going to take as a cost of doing business, so to speak.
Mm-hmm.
Yet the net return to me as an investor is literally the same. So people are going, well, Jerry, maybe I didn't really pay attention to that element here. Let's take a step back. In the Hermes wallet, the important parts of this profile that I was looking at as an investor were controlled stake, their pool margin, and their pledge, as well as an actual metric or a number telling me how many actual blocks this stake pool actually produced. As you can see, these numbers, 106, 2050, 2%, and 0.91 are in drastic contrast to this wallet's 0.180, 1 million, and look at this, 19 blocks produced. Yet the rewards are very, very similar. I always believe that it's important to take a theory and test it out. I did some game theory prior to staking based off of some math. And the math that I came up with, I was proved wrong. I anticipated receiving far less Cardano ADA tokens from Hermes than from Loveless because of the margin. Well, the truth of the matter is that because of this incredible code written into the governance model of how validation rewards are distributed and how blocks are actually chosen to be closed by a pool, the randomized fair distribution code seems to be working. Now, this has been a very short period of time, folks, but appears to be working very well. These rewards come from one epoch. So every 5 days, my Cardano, if I did nothing else, would, oh wait, I added a new wallet. So if you don't count my new wallet that I started 2 days ago, every 5 days to receive 60 Cardano on average is a wonderful return on investment, not even considering the capital appreciation of the underlying token itself, right? Today, this doesn't have a very high dollar value at 11 cents per Cardano at current market price. But let's say it went up to $1, right? Not even getting to its all-time high, just $1. Well, if I was receiving $60 every 5 days, that adds up. That
Absolutely.
adds up. And you can see we're leveraging an asset like this proof of stake reward system can create a passive income. This Beyond Moon series is all about helping you create new thinking and explore new ways to maximize returns of your investment. If I'm receiving staking rewards from a proof of stake protocol, that by tax law would be considered, I don't know. Nobody knows. Let's hope it is considered interest income or dividend income. And if that's the case, there are a ton of advantages to utilizing this method to create an income. We don't know exactly how the various governments around the world are going to interface with this new technology and define it and write it into its tax code. I'm taking a shot and a gamble that it's going to be in my favor. It'll be considered, I'm hoping and praying, IRS, if you're listening, interest income, dividend income, please. All right, that's enough for me on this. Let's go to the delegation center. And why am there's something I wanted to get to. Is it this? No.
That's basically redeeming your rewards out of the ITN in case you
Yeah, I
participated
didn't
in the
want that. I
incentivized
wanted
testnet.
I wanted the gate. I wanted the it's a dial. It's basically a metric that tells us how much of the actual blocks are being created by.
Yeah. Go
So I
back to the
that
stake
button.
pool, menu, and then there you are. There's the
Oh,
bar,
there it is right
22%.
there. Okay. Important to note, everybody who is in this ecosystem or considering coming into this ecosystem, on a sheer math adjusted basis, if only 22% of the blocks are being produced by stake pool operators today, that leaves 68% of the network its transaction blocks are not being done by stake pools. This is going to grow over time. When I first opened my wallet and started my delegation, it was at 10%. It is now at 22%. Mattias, do you see or do you understand the chronological growth of the stake pools taking more and more of the block producing for the network? Do you understand that and can explain it to us?
Yes. So this is again influenced by a parameter which is called the parameter D for decentralization. We have to think about how did Cardano mainnet work over the last few years, because Cardano mainnet is operational since years. But just now we are starting with stake pools, with staking, with decentralization. Until the first epoch started, with the stake pools taking over a few percentage of the blocks, all the blocks have been produced in a so-called federated mode by nodes that have been run by IOHK, basically. So that was a decentralization parameter of 0%. So when we started handing over some of the blocks, the block production, we always had to keep in mind mainnet has to stay stable. We have to make sure that you can still send your coins to Binance, you can still send your coins to your Ledger wallet, to your friends, or whatever you want to do with your coins. So it's no option to just jump from 0 blocks produced by stake pools into 100% of blocks. And that is not how Cardano works, because they are cautious, they are often considered slow, but it's not slow, it's forward thinking. They are taking their time and they are doing their things right. Also, it might take longer. It will play out in the long term. So what they did on the first epoch, when we started with stake pools, we set parameter D to 10%. So it's not, actually we set parameter D to 0.9, which means 90% stay with IOHK federated nodes and 10% go with the stake pools. The epoch after, we went down to 0.8, so 20% were produced by stake pools. Now we're in the third epoch, And from now on, the steps are planned to be always 2%.
Oh,
So
okay.
from tomorrow on, 24, then 26, then 28. There is a probability that IOHK decides to increase these steps in case everything's running super smoothly. But at the moment, they are set to 2% each epoch. And if we keep it that way, we will reach full decentralization sometime early next year. So I think it's around March, but don't take me literal on that, but it's something around March until we would reach full decentralization if we stick to that speed.
Well, it's a very carefully and measured plan for expansion. Now, folks, I hope you got something from this. I sure did. And I thought I had a very good understanding of what was happening before Mattias joined me. And I now know that it's much stronger. I have a deeper understanding of how this works and can make a better informed decision going forward. I'm going to make sure that I leave a way to get a hold of Mattias. He's active on Twitter, so his Twitter handle will be in the description of this video below. We will also make sure that you have the contact information for both of his staking pools if you should decide that you want to get involved. Mattias, let me stop sharing the screen because I want to see your face. There it is. Look at that handsome young man. So I want to thank you for taking the time to walk us through this. And I want to encourage not only yourself, but all of the Cardano folks to take a more active approach in the community, because I honestly believe that there's a tremendous amount of trepidation or I don't want to say anxiety, but if you're not sure about something, you're less apt to act. And the truth is, there is still a tremendous amount of ADA being locked up in cold wallets and sitting on exchanges. And I think it's because folks just don't understand the real value proposition, not only from an investor standpoint, as far as creating more of my asset, increasing my value, but also the participation in the ecosystem and what it does truly to create the decentralized network that all these wonderful things are going to be built on, and how we can influence that, be a part of that, as opposed to just sitting back and watching the world do it. We can actually participate in it.
Yeah, absolutely. I couldn't phrase it any better. So I will just leave that with you. But it's really, maybe it's kind of a lifetime opportunity that we are having here. It is time, and we have the technological possibilities to really get the power of our financial decisions back to ourselves. So get your ADA off the exchanges in case you're not day trading. Get them into your wallet. There's Daedalus, there's Adalite, there's Yoroi. There's so many excellent wallets. Get yourself educated. Send a few ADA off the exchange to your wallet to make sure that if anything happens, you're not sending everything at once, and participate in the Cardano protocol. We are now at the very beginning, and we are just seeing a glimpse of what Cardano is capable of. We see delegation now in stake pools. We have not yet seen smart contracts, decentralized applications. We have not yet seen decentralized governance, where everybody, you, me, as long as you have one ADA, you can participate in the governance and define the direction, or participate in defining the direction where this protocol goes. And there's so much more to explore. Our core focus at the moment is education, because we think even for crypto savvy people, it's not absolutely obvious in the very first point to understand all the aspects of the protocol. But even more important is to onboard non-crypto savvy people in the future. We need a very, very big percentage of the world population to participate in crypto networks. Not only Cardano, but Cardano is in a very, very good position to play a major role in this. So let's get more people involved. Let's get more people educated. We are really in a position now where we can change the way that we interact financially, but also on so many more aspects like voting, etc., etc. There's so many possibilities. We can really change the world from here, and let's take that chance. And yeah, very, very happy to see everybody on Twitter, on my Telegram channel, as delegators to my pools, of course. And thank you very much for giving me the opportunity to be on that show. I really enjoyed it. I hope it was helpful. And yeah, would be happy to come back anytime soon again and talk about the latest developments on Cardano.
Right on. So, folks, you've heard it from a stake pool operator. You heard my input as an investor. You know, I go down the checklist and I'm thinking about, does this product, does this token, does this protocol, does it have a use case? Does it solve problems? Well, we know with smart contracts and decentralized applications, there is a growing demand for that kind of sovereignty, not being controlled by central entities. Okay, check. Does it have the supply demand metrics and token economics to create value in the underlying asset? I believe so. Check. Is there a way to create a revenue stream aside from that? Well, we've just spent this entire show talking about staking your tokens to receive more tokens as a reward. Check. Now, here's the thing that nobody talks about, or very little is put towards. It's called safety and security. Everything I'm doing with Cardano and ADA and my wallet, my stake pool delegations are all happening from my computer. I do not have my tokens somewhere outside of my control. So if your tokens are sitting on an exchange and the exchange blows up for some reason, guess what? They could be gone forever. I have control of my assets. Literally have control of my assets. They're right here with me. They're not in Germany with Mattias. That's an important,
very important point
to understand this. So with that being said, folks, leave your comments in the comments section. You'll have ways to get a hold of Mattias if you'd like to ask him questions directly through Twitter. Leave your comments, subscribe to the channel, hit that like button. And remember, this is something we're all doing together, that tomorrow I will be a better investor and a more knowledgeable, well-rounded person as a direct result of the time and effort I put into my learning today. So from Germany and beautiful Costa Rica, Pura Vida.